So if you've got a company, you've got two people as shareholder, the bank will make you both sign personal guarantees. So it just means, so at the moment, she's on the hook for both. Can you guys see that okay? So she's guaranteeing these two loans, and I've just made them up, they're $500,000 each. So she's personally liable for 1 million. So if Josh comes in and he guarantees both those loans, now he's liable for the same amount. So he's liable for 1 million. So I'm surprised how many people, when I do videos around this, like just social media videos, don't actually understand this concept. So person A, his wife is liable for 1 million, and by him signing a personal guarantee, he's liable for 1 million. So between them, they're actually liable for 2 million on paper. They're not actually liable for 2 million, but in the bank's eyes, they're liable for 2 million on paper. So that just used up $2 million worth of serviceability on two properties where the loan's only 1 million. Because what Josh could do is, instead of doing this, assuming his serviceability is the same as his partner's, he could literally now he's got to have the deposit, of course, whatever that deposit is, if you're putting in 5, 10%, 20%, whatever. But he could literally go out and buy another 2 properties rather than guaranteeing the current ones. And that's why when husband and wife buy a property together, they're actually stitching themselves up and not freeing their serviceability. So now she's liable for 1 million, Josh is liable for 1 million. So they still have $2 million of liability between them. The difference is now they've actually got $2 million of debt, not $1 million in that first situation. Does that make sense to everyone? And in the accumulator course, a big part of it is, well, it's about buying highly profitable properties under market value, but then buying high growth properties. But a big part of it is actually putting these in separate structures. Because if this isn't purchased in Josh's own name and he puts it into a trust or company, and these are all self-sufficient, he can keep buying more properties. There's no limit on the number of properties he buys, except that he's got to keep chipping in the deposit. So each time he might have to chip in 10% deposit. So he's got 10% here, he might have to put in 10%. And then, to get to the next one, he's going to have to wait to either save the money, or he's going to have to wait for these properties to grow in value so he can then refinance them. And that's another consideration, is you don't want to be maxing your serviceability on one property. So if he's only got a maximum of $500,000 of serviceability, you don't want to max it on one property. You want to allow a buffer. So when this property does grow in value, and you want to be buying under market value, so you've already got instant equity. When it does have equity, you're not stuck and you can't then go and refinance that equity out. So that's been a little bit hard in the last 12 months with interest rates, doubling from the bank. So, if you allowed a buffer where you had a refinance, then, a lot of that buffer for many people has been chewed up, but it still doesn't stop you from doing a low doc loan. So there's loans that at the moment, there's one in particular, I know was CBA, and wanted to refinance to pull out a fair bit of equity, and the CBA just won't do it. They've changed their policy. So now I'm having to go to a second tier lender to do the refinance. I have to pay a higher rate, it's like 0.75% higher than what CBA are offering, but a 0.75% means I can access a whole lot of equity. And then I can then use that equity to go and buy another property and another property. And in this instance, that equity can actually buy quite a few properties.